it's important to note that a lot of pension funds, endowments, allocators make decisions not on a daily basis like most of crypto investors, but more on a multi-year time frame. And seeing someone like JP Morgan step into the space in a very meaningful way, it definitely computes and factors into the decision of how much you allocate into crypto funds, into strategies like ours. And those decisions get made year end, and that deployment cycle begins Q1, Q2 of next year.
The Federal Reserve is getting crypto curious, the federal government shutdown is getting close to the record, and trade war worries are still wreaking havoc on the markets. Hello and welcome to Milk Road Macro, the podcast that's here to remind you that the best thing to do when you're $38 trillion in debt is to stop going to work. I'm your host, John Gillen. Today is Friday, October 24th, and this episode is scheduled to be released on Tuesday, the 28th. We are joined today by one of the young wizards of Web3, Santiago Santos. Santi is a prominent digital asset investor and the founder and CEO of Inversion Capital, where he focuses on building digital asset infrastructure in emerging markets like Latin America. Previously, Santi served as a partner at Parify Capital, one of the largest DeFi-focused funds. He has backed over 150 startups. He brings experience from traditional finance into the world of Web3. Santi is going to break down the Fed's recent payment innovation conference, stablecoin adoption, and a whole lot more than that, what it all means for macro. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who needs to hear it. And as a reminder, this market moves fast. Milk Road Macro is here to help. Twice a week, our macro newsletter team breaks down what's driving Bitcoin, tech, and the economy, all in plain English that's easy to understand. So subscribe to our free newsletter to get in on the alpha there. The link is below in the show notes. And without further ado, welcome to Milk Road Macro. Santi, how are you, sir?
John, thanks for having me. It's great to be here.
I'm really excited for this conversation. I've been trying to get you on for a long time to talk to you. So got a lot of questions. And I thought a good place to start was with this payments innovation conference that the Federal Reserve held this week. This is a huge shift in policy and in tone from the Federal Reserve, much more positive towards crypto from them. What are some of your thoughts on this? What are some key takeaways? I know you weren't personally there, but what do investors need to know coming out of this conference?
Well, I mean, let's set the stage, right? You have a very different administration, regulatory environment as it relates to just broadly innovation. Certainly in crypto and AI were the two important topics on the agenda. You know, the Fed just signals more willingness to explore and adopt and leverage this new technology. So it really, I think it sets a tone that is a total 180 to what you had in the prior administration. There's a couple of key things that were top of mind and discussed. One, of course, digital assets, stablecoins, and tokenization. The other one is just AI and agentic payments and just broad financial infrastructure. And so, and the last point was just access to the Fed payment system, FedNow, and master accounts from non-bank institutions. And all that really ties into stablecoins. It ties into obviously AI and agentic payments. And so, look, there's a lot of folks in the room. There's BlackRock, Coinbase, Stripe, Google, Franklin Templeton, a lot of folks in the room. And so it was a really good conference that sets the stage for, you know, what potentially might come from a regulatory standpoint. You know, we probably will talk about the Genius Act. And so overall, very positive for the space. And we'll just see what comes out of that.
Yeah, I want to kind of break these things down kind of one at a time and get your thoughts on this, because I know some of this relates a lot to the work you do. But I wanted to start with that announcement from Governor Waller. He's proposing giving payment accounts or what they called skinny master accounts to stablecoin issuers, which would allow them to get direct access to the Fed's payment infrastructure without having to partner with a bank. I wanted to kind of get your thoughts on this. How important of a shift would this be? Does this have a big impact on the banks? Would they fight this kind of a proposal? And how much would this help stablecoin issuers?
Well, who wins here? Stablecoins, stablecoin issuers, and neobanks. Folks like Robinhood, Revolut, Nubank, these bank light, regulatory light financial institutions, right? Because they now have access to really leverage stablecoins and get access to the Fed rails directly. Why is that important? Because you bypass traditional intermediaries. Who are those, and which folks actually lose are banks, particularly medium-sized banks, small-sized banks. Will make it harder for these banks to maintain their position in a world where you can circumvent them. So that's the first point. The second point is It's important because, as we know with stablecoins, you just lower the settlement risk and cost in digital transactions. As much as stablecoins are just a better global borderless financial rails, you still had to interact with payment traditional intermediaries to do on and off ramping and primarily. And so bypassing them collapses furthermore the flow and the cost to move a lot of the payments flow over to stablecoin rails, right? Overall, I mean, it just increases the competition in payments. And
Right.
so the ultimate beneficiary here is the consumer. You're going to get or businesses, you're just get your money faster. There's less fees. And that is just a very, very step. I mean, it might be one of those things where you look back in a couple of years and this skinny master account proposal might be one of the more important things that not many people are paying attention to just yet in crypto.
Yeah, I really appreciate that insight on that. That's exactly how I felt hearing this proposal, because it does seem like an enormous, like a tectonic shift in just how the government is thinking about these businesses and treating them. I think that, something I'm curious about is the banks are obviously in some capacity going to try to fight and resist this. I think one of the battlefields we're seeing that play out on is this Clarity Act proposal that's in Congress. If the shutdown ever ends, the Senate is likely to resume that. Do you have any thoughts on this fight that we've seen between the banks and stablecoin issuers about offering yield-generating products? How does that play out in the likelihood of the Clarity Act passing? How is that fight going to unfold? Or do you have thoughts on that?
Well, I think banks will fight it. It's normal because they stand to lose. As it relates to passing regulation, look, the government shutdown is probably the most important thing there, just because government is going to be just slower. There's been probably a subdued pace in new regulations passing, which makes me a little bit nervous. I think earlier this year we just saw way more traction in Trump administration coming in and the Genius Act passing, and so. I think it's a part government shutdown, part just a little bit of lost momentum on some of these bills that are going to be important. But, nonetheless, I mean, the Fed, days like, these proposals by the Fed, I think are signal just a lot of strength, right? Going back to, again, before November in this new administration, a lot of people ask themselves now, it's like, hey, what happens in 3 years? What happens in 4 years when you might have a different regime, different administration? Are we going to peel all of this back and go to a state where crypto is back in square one? And the reality is the cat's out of the bag. Like, you just open, we're not going back. And so from a regulatory risk perspective, I think this industry continues to be massively de-risked, but policy takes time. It is, again, I can't underscore how important this direct access to central bank money is for stablecoin and tokenization issuers. It's always been this tension where integrating the traditional analog world to the digital world and stablecoins, there's always friction in that interaction. This proposal, it's a sort of I would describe it as a missing link to really create more efficiency, more fluidity, remove some of the friction for neobanks and just stablecoin issuers to, USDC, PYUSD, all these guys. I mean, it just will create much more efficiencies in that flow.
Right. Yeah, and this is one of the reasons why it stood out to me the most. Like you said, there was a lot of things that they talked about at this conference, but that was one of the biggest things that came out of it for me too. I'm really interested to see the downstream impacts of that policy change. I want to kind of zoom out a little bit more broadly around stablecoins. I want to bring in Inversion Capital in a minute and talk about the work you're doing there. But you mentioned the Genius Act. The United States has very much made it clear that stablecoins are part of their plan to continue to fund the U.S. government, and the Genius Act has kind of made that possible. But I'm interested in your thoughts on how, we talked about the banks kind of fighting some of this stuff internally in America. I'm curious your thoughts on other countries' reaction to this, because for other countries with weaker currencies, there's a risk of a lot of capital flight into the dollar as stablecoins start making dollars more accessible. What are the responses going to be from other central banks? What are you expecting to see there? What's that going to look like?
Excellent question. We spend a lot of time looking at companies in places like, in Latin America, in Asia. Why? Because that's where most of the stablecoin adoption has happened on the consumer side, on the retail side, right? And so the common question that we get asked is, will central banks, will governments, local governments resist that? Will they clamp down on dollar-denominated stablecoins? Because there is capital flight, right? And we've seen time and time again, like China, for instance, has banned Bitcoin a couple of times. India has at certain times, try to clamp down for the same reason, right? Bitcoin, no different than a stablecoin, allows you to move your money from a trapped capital market, local economy, and that's problematic. I think some certain governments might have an issue. I'll tell you, I've been interacting with regulators outside the U.S. I think most of them just appreciate that they don't have a choice. It's just a nature of the beast. It is a new regime. They can do certain things to clamp down a bit on it. They can set certain, this idea that people can save and earn yield in dollars and have a dollar-denominated bank account while they live in that country of choice is a very, very new paradigm. Why would governments not like it? Of course, is for, it just destabilizes the demand for a local currency. But the reality is, John, people still need to pay. If you're a business, if you're a retail person, you might want to save in dollars, but you still need to pay in local currency. Unless you're like, very few countries will be like El Salvador that are dollar denominated. A place like Mexico is still going to have their local currency and is going to need, and so it just increases maybe the FX pair dollar peso. You're already seeing a lot of remittance flows go from, through stablecoin rails. People are, in my conversations with folks like Bridge, right? They're seeing a lot of consumers not off ramp to local currency because you have now a digital wallet that acts like a bank account, especially now perhaps with this new regulation, right? From the Fed, and is regulated. It is a dollar, a digital dollar. Governments like it for this reason. Most of these countries are cash-based economies. If you're a cash-based economy, the government doesn't have an understanding and can't tax that economic activity. People are gonna hate me for it, but you see right there in the back, Brave New World. Governments love surveillance, and when money is digital, you can tax it. You understand economic activity. You can, and so you gain that, right? In certain places like Mexico, it's a heavily cash-based economy. Brazil, on the other hand, has introduced digital payments called PIX that has transitioned a lot of the flow from cash to digitized Brazilian real. So again, these are some of the trade-offs and some of the considerations, but net, it's one of those things where it's not going to change, but you want to have more visibility into what's happening, transactions. And as soon as stuff is digital, governments like it because they can clamp down on organized crime and nefarious activity and tax avoidance and all of these things. They get the benefit once money is digital.
Right. Yeah. There's a lot of benefits to a lot of stakeholders. And I totally agree with what you're saying. I think that governments will recognize that there's an opportunity for increased surveillance, control. So I'm kind of interested to see what some of those, capital control policies look like. But I do expect more of that to be coming. So we'll monitor that situation. I want to pivot now to inversion capital and stablecoins more broadly, but I thought it would be good for you just to kind of lay out for our audience a bit of what you're doing, because I think a lot of people are not really seeing exactly where the rubber meets the road on stablecoin adoption. So could you just walk us through Inversion Capital's strategy, the telecom companies you've been working with, how you're driving crypto adoption in Latin America, and what are some of the results that you've seen from this with early on adoption with stablecoin integration?
Yeah, just zooming out, like what is Inversion Capital? What do we do? Why do we exist? I see a huge opportunity in introducing and making businesses more efficient with this technology. And it is a private equity strategy. We're looking to buy controlling stakes in businesses and replacing antiquated infrastructure and technology with this new technology like stablecoins, right? Because it changes the game. It allows you to serve customers better, faster, and cheaper. And it changes the ability for a business to go borderless finance, right? And so that's like the opportunity that I see. It really started from this frustration that I've had since I've been in crypto since 2012, which is, why don't we have more users, right? We talk about the benefits of this technology. People are appreciating it more, but we have, 40 million users, active users in crypto today. To put it in perspective, ChatGPT has 800 million users. So we're a $3.4 trillion asset class with 40 million active users. Something is not translating into why this technology hasn't been adopted. But in summary, we see over the next 20 years, 20 plus years, every business is going to interact and use this technology. We want to accelerate that. We think that we can deliver very interesting returns for our investors by doing that, not by relying on financial engineering that most private equity funds just put a bunch of debt on a business, hope that rates come down. No, we use technology to drive value. And so it's not just telco, it's consumer finance, it's trade finance, it is, and the interesting thing is there's already businesses that are doing this. Like Figure Technologies just went public. They've been doing some interesting stuff in the HELOC market. Why? Because they can underwrite and then they can extend loans faster, better, cheaper for their consumer. They're issuing 15 billion of HELOCs. That's not a small amount, right? And so that's the opportunity that I see at Inversion, which is everyone in crypto is trying to export this technology from the inside out. Well, good luck trying to convince people to download a digital wallet and figure out security. And furthermore, we are not going to onboard 1 billion users to this industry through an exchange. It's just a very limited audience that wants to go to an exchange and gamble their paycheck to paycheck. It's a big industry, but it's not worth 3.4 trillion. I'll tell you that. But what gets lost when everyone just talks about price and speculation is underneath it all is a very powerful technology like stablecoins that every business will be using. And we want to be there first because we think that we can unlock a ton of value.
Really helpful insights on that. I think that's a great change in the way of thinking about what adoption means. I'd like to hear about some of the challenges and I guess some of the wins that you've unlocked here when you're doing this. Because like you said, you've onboarded a lot of people into digital assets. How has that gone? What's that learning process been like? What surprised you there? And then, beyond Latin America, how do you see this adoption scaling more globally?
Mm-hmm. Look, I mean, it starts with I've been obsessed with just looking at a company, income statement, cash flow statement, balance sheet, and understand like why is that the business has like a 5% EBITDA margin? Why is it that accounts receivable or is such? And really understanding where friction points are in the business operation. Key learnings that I've had since I started Inversion, almost a year ago, was way more reception to this technology. And I started Inversion when the new, Trump administration got elected because, it does matter. I couldn't have started Inversion 4 years ago when I left Parify simply because the regulatory environment was not there. And we didn't have enough, the technology was not there either. And now you have high throughput blockchains where you see a path towards this technology serving billions of users, right? So I'll tell you a process. We were looking to buy one of the largest telcos in Latin America. That process was being run by a big investment bank, one of the largest banks that has historically been against crypto. And we went to them and said, listen, we want to buy this company. This is our value creation story. This is what we want to do with this business. Go pitch it to your client. And I candidly thought that it would have been DOA, right? They would have said, our client's not interested in your crypto story. They are very traditional. And this bank is also very traditional, but they came back to us and said, no, the client's interested actually. And so we got in the door, we spoke with them about our value creation story that relied on decentralized physical infrastructure networks like Helium and relied on using stablecoins to create that telco into financial, a bank essentially, and offer financial services to that user base. And that it stuck with them. Not only that, but they were interested, right? And so I think that is really a reflection of the state of this industry where we're no longer being discounted too much. I'm very intentionally building in the open. You'll hear me say time and time again, I think every business is going to use this technology. We have more inbound of businesses that come to us and say, hey, I hear that you're looking to buy or partner with businesses. We'd love to pitch to you how we've been interested in this technology, just don't know how to implement it. And that's really you always as an investor, you got to ask yourself, like, what's my edge? My edge is I've been investing in this technology since, 2012. But I've done private equity before. I've done growth equity before. I worked at JP Morgan. I worked at some of the best growth equity funds. And so from that standpoint, I think it sort of is overlaying these converging worlds. And I'm less interested in making the incremental venture investment because more value will be unlocked by deploying this technology than building de novo, like from scratch. There's already really good technology that's been built. Now is the real opportunity that I see is deploying it at scale.
Yeah, and I'm really interested to see what deploying it at scale turns out to look like, how that evolves from here. But this is one of the reasons why I wanted to have you on this show, right? It's called Milk Road Macro, and a lot of times, the Fed has a conference, big whoop, what's the deal? But you're actually seeing where this meets the road, where companies are actually using these things, and what that adoption looks like. I wanted to get your thoughts on this. What do you see as being the core value proposition here? Is it a better user experience? Is it cheaper, faster? Is it all those things? And what in your mind does a moat around this business look like? I mean, like, are you worried about, just endless new competitors coming out with faster, cheaper solutions? How do you protect this business in a world that is rapidly innovating towards better and faster payment solutions?
Well, we always say we lead with business logic, not ideology. And again, user aggregation theory is very real, which is in the internet, right? There's few companies that have a very strong relationship with the end user: Facebook, Google, Amazon. They've captured immense trillions of value because they capture attention and they provide a service and then they expand on that. And so that will be true with crypto and it will be true with AI. And so again, I think the point around this technology, it is open source, right? So if you're a stablecoin issuer, difficult business to be in because everyone will want to issue a stablecoin. If you're a blockchain, a layer one selling block space, difficult business to be in because block space is a commodity. What is rare is finding the user and the activity, economic activity that wants to be settling and using this technology, whether it's stable coins or decentralized physical infrastructure networks. No one in crypto has solved that. Perhaps the few people that have created the most amount of value in crypto are exchanges because they, again, maintain and have created a strong relationship with the end user. Binance, largest financial institution in the world, right? Fintech, Coinbase, Kraken. All of these companies have one thing in common, which is they aggregate and they capture and have developed a strong relationship with the end user. At Inversion, we see a similar opportunity and moats around buying businesses that have that connectivity and distribution with the end user, right? Because the end state of this technology is users should never focus on infrastructure. They don't care how things work. They want a service. And you, John, don't care when you click your email and send an email. You don't care how that email gets to the other person. You don't care how, when you get on a plane, if it's a Rolls-Royce engine or whatever wiring happens, and if it's a Boeing aircraft or a Bombardier, like, you just don't care, right? As long as you get from point A to point B in time, you don't care. And the price is competitive. You don't care. And I think that's where this technology will eventually go. That's the end state. And so at Inversion, we're very focused on, we're going to, consumer behavior doesn't change. As much as technology comes and improves your life, consumer behavior will not change. So our thesis is, for instance, a lot of the apps in your phone, in 5 years' time, probably don't change. You're still going to have a banking institution. You're still going to have an e-commerce provider. You're still going to have a streaming provider. You're still going to have an email client. Question is, which of those businesses can we buy at a good price, interesting price, that we can make vastly more efficient on the back end? And so that you, John, might still have that same app in 5 years, but all of a sudden that service is better. Like, think about the evolution of the first generation, second generation, third generation iPhone. It was a good product. The form factor was great. Like Steve Jobs, I mean, this is why Apple's so valuable. But internet was terrible. The App Store, not. But it captured your attention, and the form factor, they just nailed that it created an entire new category called smartphones and rendered BlackBerry, Nokia, and a number of other companies bankrupt. Now, this is where crypto is. You have an interesting form factor called decentralized finance, called blockchain, trustless execution environments that allow for use cases like stablecoins, where the end customer definitely sees it, definitely feels the impact because they get access to credit. I mean, my God, in places like Mexico, we see the opportunity to buy a telco business and offer that end user a bank account With one click, you have a digital wallet. With one click, they can receive remittances. Faster, better, cheaper. With one click, they can earn yield. With one click, they can now invest in the US stock market through tokenized stocks. You totally transform that business. The end user doesn't care about blockchain. They care about preserving wealth and earning more and getting, at the end of the day, served a core service, right, in a competitive way. And so, that's what we're very motivated. It will happen. Like, again, there is no version of this world where the world wants access to dollars. Stablecoins fill that need, that demand in a very real way. The challenge and the opportunity is how do you do it in a way that puts it in the hands of the consumer in the fastest and easiest, frictionless way. Because right now the crypto industry is requiring your grandmother to set up an account in Coinbase, and the first thing your grandmother sees is a 50x perpetual long product on a shitcoin called Dogecoin. Well, that's probably not the best form factor for this technology.
I think that's a really helpful and maybe obvious, but really, really helpful insight to illuminate that. But I really like that reframing, right? It's like you said, there's going to be a lot of stablecoins, a lot of stablecoin issuers, and block space itself is a commodity that other people can compete for. But what they can't replace is users, is repeated economic activity, is that reliable return repeat business. And that might be the key and most valuable piece going forward. Really, really helpful perspective on that. I want to ask you about something else. You touched on it briefly, but the Fed at their payments conference talked about the intersection of AI and payment systems. And I'd love to know your thoughts on this because, like you talked about the end user and so forth, there's a world in the future where there's a lot of agentic AI operators that are going to be users of stablecoins and payment solutions. And I'm curious to know what your thoughts are on that, or if you're already in some way thinking about how to involve AI in the work that you're doing at Inversion Capital, and just what does the future look like there?
The answer is absolutely. I mean, AI has transformed our workflow. I mean, we're a small team of 10 with big ambitions. We've been incredibly efficient with AI in our workflow. So I keep telling folks that we hire is you'll likely don't get fired or replaced by AI. You'll get fired and replaced by someone that actually knows how to use AI. And your question around agentic payments, look, huge topic. Everyone's paying attention to it. Stablecoins fit squarely into unlocking that possibility, right? Because if you want to empower an AI to do stuff, to pay for a subscription or run a portfolio management strategy, the natural choice here is stablecoins. Why? Because you can't KYC a bot, right? And so stablecoins allow you to do that, right? And it's just from a settlement standpoint, from an execution and speed standpoint, just stablecoins will be the preferred choice for AI agents and agentic payments or workflows. And so that's really how these two worlds converge in a very meaningful way. I recently invested in a company that a couple of folks from Stripe left and saw the opportunity of both worlds, right? Of stablecoins fitting squarely into agentic payments. The analogy here is people may have forgotten, but Tim Berners-Lee, the inventor of the internet, said, we were very good at solving the information layer for the internet stack, moving information at the speed of light as you send an email. They never solved the moving the money aspect because it was very hard. It takes trust and coordination into intermediaries. Stablecoins do that, right? Blockchains are very good systems that don't rely on trust and trustless execution environments, right? They're reliable, are predictable, and this other component of programmability of the money, because stablecoins allow you to actually introduce a lot of flow more natively into whatever it is that you want that agent to do, so that it doesn't go berserk. But you need to have certain guarantees that it's like, hey, look, I want you to do X, Y, Z within a certain parameters. The seventh wonder of the world is programmable money. Allow you to sweep interest. I'll give you a very simple example. You know how much money your rates have been now at 4 or 5%, right? You, John, sophisticated as you are, don't keep that much money in your bank account. You go and sweep it to a money market account or buy treasuries to earn 4 or 5%. You know how much money was sitting in checking accounts over the last 4 years where rates have been elevated?
No, I don't.
A staggering amount. Most people don't have financial literacy, right? And so who wins and who loses in this new world where agentic payments and AI agents can, optimize and make money work for you?
Right.
I think you're going to see a lot of financial institutions, primarily neobanks and startups, trying to disrupt and take market share away from large banks that have been, for better or for worse, have just been clipping all that 5% on that flow. In a world where you have programmable money, as opposed to you having dollars in your checking account, you have a stablecoin. And what does that stablecoin do? It says, John, I recognize your cash burn. You typically spend X amount per month. I'm going to leave that in a checking account. In real time, I'm going to sweep it so that you're earning 3-4% of your money without questions asked. It will just do it for you. It will, again, this skinny master account proposal just facilitates that in and out of a money market account. And John, you don't even think about it. You don't need to have to, figure it out. You just have certain guarantees that your money's going to behave in a way that works for you without you having to, really get your bearings on it. And that's really it. I mean, there are certain things that technology comes and improves our life in a very meaningful way. It does it because it doesn't assume that you're going to change and require people to do anything different in their day-to-day. And the reality is the educational system teaches you about calculus and World War II, but it doesn't teach you how to use money. And so that's right. We can sit here and pontificate that should change, but it will never change. Like, people just don't have financial literacy. This is why programmable money and stablecoins with AI will transform consumer finance.
That's really, I think I hadn't even thought of that. I was thinking more in terms of like Shopify and ChatGPT, cutting out Amazon, but in terms of like how it affects people's personal savings and checking accounts, it makes a lot of sense. And you're right. That is, I only keep the money in my checking that I have to spend immediately, so that is how I use that.
On that point, you're totally right too. I mean, checkout is one of those experiences that you still live in a world where your credit card can get denied. Like, you have chargebacks, you have payment processing fees are high. But this idea of like failed checkout is billions, if not trillions of dollars left, abandoned cart because your credit card doesn't work and gets rejected for no good reason. That does not happen in a world where you are settling on a blockchain and you have atomic transactions. The business gets paid faster. You, John, can pay. So let's imagine Thanksgiving's coming up, right? Thursday, the
Black Friday is the
Black Friday. Yeah, Black Friday.
There you go, yeah.
We talk about Black Fridays here, but it's not as a pleasant experience as Black Friday. You want to buy a TV or PlayStation because it goes on sale. Now, God forbid, you don't want to sit outside of Macy's or Target or Best Buy because there's a stampede, right? You want to be sitting in the comfort of your home and be sleeping. So you instruct the agent to buy this online. Your credit card might fail because for whatever reason, typically, sometimes it fails. But with this programmable money, you can instruct it to buy within certain parameters. If the price of the TV is less than $399, go buy it. And by the way, that transaction gets immediately executed. You have the certainty that it will go through. And the business on the other side sees that, receives the money faster, sends you the TV. There's still some flow that needs to be figured out. Escrow, say you, John, receive it, it's broken, you want to return it. So how do you fix that in a world where like the settlement's like there and irreversible? But we'll get there. I mean, it's just the faster, better, cheaper is there, right? Businesses love it, because they don't have to figure out match. Going back to why inversion capital, a lot of what you focus on is in inversion is what is the working capital of that business? Do they get paid in 30 days? Can we compress that to 2 days? Because then that releases so much cash, and then so you don't have to have that much credit. And so there's all these economic impacts when you start using stablecoins that are very material for many businesses.
This is really helpful, and I think kind of really illuminates for a lot of people some of the depth that goes into stablecoin adoption, what the opportunities are there. We don't have a ton of time, but I want to get a few more questions in for you about tokenization and institutional adoption. One of the things that the Fed talked about was tokenization. You were at the Blockworks Digital Asset Summit in London, and I wanted to kind of get your thoughts on that. One of the big focuses at that conference was tokenization as well. Tell me, what were some key takeaways from there? What were some surprises for you? And what is happening with this big push towards tokenization? Is this really taking place, or is it still really early stages? Because the stablecoin is just a tokenized dollar, but where else are we seeing tokenization progress and get adoption?
Great question. Yeah, most of the tokenization efforts right now have been stablecoins. It's easy, right? You're tokenizing a digital dollar. It is now regulated. It represents a dollar in a bank account for the most part, and so it's easy to transfer, right? And there's another area of tokenization focused on real world assets. The vast majority of those have been still fairly simple liquid instruments like tokenized treasuries. And then you have a sort of a increasing interest in tokenizing, HELOCs, for instance. Figure is now a public company. They've been focusing on the home equity lines of credit. They are probably the largest RWA issuer, ex stablecoins and tokenized treasuries. I think they've issued over 15, 16 billion of RWAs. I think there's a big push in the industry to explore other types of real world assets. I would say it's still in its infancy. I think there's still elements and workflows that we need to figure out. I've been cautiously optimistic, primarily because market structure is not there. You need to figure out, when you look at 2 Fridays ago, the real Black Friday, when you have a total failure of centralized exchanges, APIs, it poses the real question of, hey, what happens? Like, are we ready to start tokenizing more illiquid, bespoke, niche, I would say, instruments? And I'm not sure we're there yet. I think that's a gap in the industry that I think we still need to figure out. I think it's much easier to tokenize treasuries, dollars, less tokenizing, less liquid, more niche products, but we'll get there. I think a lot of what crypto is really good at is price discovery and secondary markets, and a construct like AMM, right? It's been very good to allow us to get price discovery on a very tail end of risk assets, and so I think you can see that similar flow for tokenizing just random stuff. But the oracles, how you stitch together this real world versus digital world, and if you're bringing real world assets, the reconciliation, the settlement, the unwrapping, wrapping, those are some of the things that I think just are in its infancy. But you can see a world where in 5-10 years, a lot of stuff is going to get tokenized.
Yeah, and I think that it's that was a big focus of the Fed's conference, right? Is like regulatory compliant DeFi, regulatory compliant tokenized equities, bonds. So that is being worked out, and I think like we talked about, the Clarity Act, I think is a big piece of that. So we'll see the progression there. I think that there's a lot of real attention and force behind the movement, though. So I'm interested to see how that changes and where that goes from here. I wanted to get your thoughts on something else. Vanguard and JP Morgan recently announced that they're going to start offering access to crypto products to their clients after both of them spending years saying they would never do so, and saying it was rat poison squared, things like this. This, again, it seems to be another huge symbolic turning point from major institutions, similar to the Fed's pivot on tone that we saw. What happens from here? How much capital is this going to bring into the asset class? And just what are your thoughts on this huge shift and pivot we've seen from industry titans like Vanguard and JP Morgan?
I used to work at JP Morgan in the investment bank back in 2012, and I started buying Bitcoin back then, and very different state of the world. A bit surreal to see. I mean, look, the reality is JP Morgan has been exploring blockchain for a while. It has a very big team. They have Connexus. So not a surprise from that front. I think most people hadn't appreciated that, but certainly allowing their customers, their banking customers, to custody, get exposure to Bitcoin is a big unlock, right? Most of the ETF flows, and this is the metric, just monitor ETF flows, because most of the demand for ETFs has been from RIAs, not from large institutions, which, JP Morgan is the largest financial institution in the US. And, Vanguard's not small either. And so it unlocks a lot more capital into the space. It signals more legitimacy. Again, to this point, we're not going to go back to a state of the world crypto is deemed rat poison. I mean, that era is over. Now I think you're going to see more and more clients get exposure and get off of zero. So we've been talking about tokenization, we've been talking about stablecoins, but the reality is most people can't even pronounce Solana or Ethereum. They're just no Bitcoin, but that's a good step forward. It's a Trojan horse, and now they can custody it within the convenience of their banking provider and relationship, and that brings so much trust to this space, and that is very positive.
Yeah, I agree with that. I think it's just something I wanted to kind of get your perspective on. It's clearly a huge positive shift. Okay, so we've talked about a lot of things, right? We've talked about the Federal Reserve's pivot, Vanguard and JP Morgan's pivot. We talked about stablecoin adoption, what that kind of looks like, and touched a little bit on tokenization. As far as the macro picture, the macro backdrops, what is the next step that you're watching for on this path towards tokenization? Is it the Clarity Act? Is it something else? What's the next thing to watch for in Q4 here?
I don't know if in Q4, but certainly the Clarity Act, I think, is very important. That might take a longer time. But, I think, that would be really it from a regulatory perspective. I think, we're going into we're going into year end. It's important to know that a lot of pension funds, endowments, allocators make decisions not on a daily basis like most of crypto investors, but more on a multi-year time frame. And seeing someone like JP Morgan step into the space in a very meaningful way, it definitely computes and factors into the decision of how much you allocate into crypto funds, into strategies like ours. And those decisions get made year end, and that deployment cycle begins Q1, Q2 of next year. So from that standpoint, I think, we now, I wouldn't necessarily say that the Clarity Act is essential to bring much, much more interest or liquidity from sources that haven't existed in crypto. The things that I worry about, obviously, is, we're in a world where Jensen Huang is equally as important as Jerome Powell. I think there's a lot of AI hype. How that hype cycle unwinds or continues to evolve, and that music continues to persist. I think AI is very real. I think, but at the same time, there's a lot of expectations baked into how quickly and how that translates into making businesses more efficient, given this huge spend in CapEx. So these are sort of things that I'm monitoring. I think, the reality is, as much as we love this technology, crypto is and will continue to be a very volatile, NASDAQ beta asset class. And the correlation between M2 and Bitcoin prices is very strong, has been strong, will continue to be strong. So things I'm monitoring is just ETF inflows, outflows, DATs. I think MicroStrategy aside, there's been just a lot of DATs coming out in the space. Not all are created equal. I think there's going to be quite a unraveling there for many. I think people are just going to realize that if you put, dog shit into a new wrapper, it's still dog shit. And
it's pronounced fartcoin.
Yeah, it's like CDS Square. I think we continue to make the same mistakes, but DATs have done interesting stuff in a world where you don't have ETFs or certain crypto products. People can express a view. Again, it goes back to the convenience of expressing a view, right? As opposed to you creating an account on Coinbase, you now can buy a DAT that gives you exposure to perhaps a crypto asset that you might not be able to buy through your bank. And so I get that, but at the same time, we need to focus on the fundamentals of this industry. Again, I'll say it again. We have 40 million active users. It's a $3.4 trillion industry. That equates to 74,000 per active user. ChatGPT is worth 500 billion and has 800 million customers. That's 625 per customer. Do we really think, and can we justify valuations? We talk about AI and crypto, both really important technological revolutions. I don't think that the crypto user should be worth 100x more than the AI user. We need to figure out how to bring more active users to crypto. And that's the reason why I started Inversion. I mean, I'm not going to sit here and pontificate of why this technology hasn't gotten adoption. I'd rather just go buy a real business and bring real GDP on chain that is not people buying fartcoin 50 times perpetual product.
Santi, look, I think this has been a really helpful and illuminating conversation. I think it's shed a lot of light on not only the adoption and growth of this industry and sort of some of your thoughts on the path forward, but it's really changed a lot of, I think, people's presumptions and perspectives on things. And so I think that's just been really great. And I'm glad we got to have you on to share this with the audience. So appreciate you coming on today. Where can we send people to find more of you and your work online?
Definitely. So I'm on Twitter at Santiago Roel. You can visit our website, inversioncap.com. We are hiring. I'm hiring sharp investing folks with private equity experience that like crypto, hiring engineers that want to deploy this technology in real companies, not just build the incremental, decentralized exchange for meme coins. So we have a lot of great folks on the team. So if you're interested, if you want to, if you love this technology but are frustrated that it hasn't been really adopted at scale, this is the company for you. So I'm very motivated to continue to build the team because I want to build the next KKR doesn't look like KKR, or the next Blackstone doesn't look like Blackstone. The best private equity fund of the future will start using this technology, and we're going to do that.
Well, I wish you the best of luck with that. I'm rooting for you, and I'm looking forward to seeing what you build for the future. Santi, thanks so much for being on Milk Road Macro.
Yeah, thanks, John. Great to be here.
Absolutely. And thank you all for joining us. If you got value out of today's episode, make sure you like and subscribe and share this episode with someone who needs to see it. And until next time, stay bullish, stay safe, stay educated, and we will see you all on the next episode of Milk Road Macro. Thanks so much, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.